JEPI losing its appeal with this major flaw. This article was written by Kevin Shan. Summary: JEPI is a fund designed to provide income and offer lower volatility compared to the S&P 500. The fund performed extremely well during 2022, but this type of performance is not guaranteed. Limited upside potential from both the stock portfolio and covered call strategy can cause JEPI to underperform long term, especially if the fund doesn't protect its downside enough. JEPI's distributions have been volatile and tax inefficient. Distributions since its inception have had a standard deviation of 9.31% and are primarily classified as ordinary income distributions. Better alternatives have emerged since JEPI's inception, with GPIX and SPI being the main candidates for replacements. Since writing an article about the JP Morgan Nasdaq Equity Premium Income ETF, PQ, where I discussed how it was no longer that attractive, I had received multiple requests for my opinion on the JP Morgan Equity Premium Income ETF, JEPI, which I will be sharing in this article. I went into my deep analysis of JEPI thoroughly, expecting to write a positive article on the fund. Its performance in 2022 and 2023 was undeniably good and showed how the fund's strategy of actively selecting stocks to lower volatility and writing out of the money (OTM) calls on the S&P 500 via ELNs had led to superior performances during bear markets. In preparation for writing this article, however, deeper analysis suggests that JEPI isn't as good as people make it out to be, especially with the numerous alternative solutions on the market. First, the lower volatility and downside JEPI provides are largely determined by proprietary stock selection strategies that do not necessarily guarantee lower downsides. This is not a good combination with its covered call strategy, which caps JEPI's upsides and makes it more difficult to capture the much-needed recovery gains after large market drops. Distributions from JEPI's ELN option strategy are not particularly stable or desirable, too, as distributions can vary heavily based on volatility and are taxed largely as ordinary income. Although JEPI's performance has been good enough for many income investors and retirees, one should consider opportunity costs. Both Goldman Sachs S&P 500 Core Premium Income ETF and NEOS S&P 500R High Income ETF, SYI, are ETFs I prefer over JEPI, as they capture the upside potential better and distribute more stable payments that reduce the need to lower share price volatility in the first place. JEPI's success. In 2022, JEPI is an extremely popular fund among retirees due to its strategy of providing large monthly distributions and maintaining lower volatility compared to the overall market. It doesn't matter if JEPI underperforms the overall market in the long run. A key focus for many income investors is to generate income to support their retirement. Share price and capital appreciation are less of a concern, so long as the overall portfolio is not going down in value. JEPI is a fund that fits this description, and it showed its worth during the 2022 bear market. JEPI had outperformed the S&P 500 in total returns between January 1st, 2022 and December 31st, 2023. Indeed, JEPI's volatility has also been consistently lower than SPY since its inception. There are two fundamental components to JEPI's strategy that have helped the fund achieve these results. The first component is JEPI's active selection of stocks that lower volatility. What you'll notice when you first look at JEPI's holdings is that their sector concentrations are very different from the S&P 500. For example, technology only occupies 19.33% of JEPI's portfolio versus the 32.70% in SPY. This smaller concentration of technology in JEPI has been spread across the other sectors, leading to less sector risk. Moreover, JEPI does not select all of the S&P 500's constituents and holds its stocks in more equal weight positions. Its top holding currently, Meta, only occupies 1.80% of the portfolio versus the same stock taking a 3.08% position in SPY. Not to mention that SPY's top holding, AAPL, occupies nearly 7% of the portfolio. By taking more of an equal weight approach, JEPI has managed to lower single stock risk significantly. The second component of JEPI's strategy that has helped lower its volatility significantly is its strategy of selling covered calls on the S&P 500 via ELNs. This is also the component that generates most of JEPI's monthly distribution. The reason selling covered calls can help lower volatility is that the option premiums generated by covered calls increase with volatility. With these two components of active selection of lower volatility stocks and covered calls, you can see how JEPI navigated the 2022 bear market so well compared to the overall market. A more evenly distributed portfolio among sectors in JEPI helped neutralize some of the big losses driven by tech and consumer discretionary stocks in the market cap-weighted S&P 500. Additionally, increased volatility led to increased option premiums from JEPI's ELNs, which offset losses significantly, with 2022 being JEPI's year with the biggest payouts. In theory, JEPI is a fund that will drop less than the overall market while simultaneously increasing its payouts during downturns. And based on what we saw in 2022, this theory has shown to work so far. Why then am I rating JEPI negatively? The importance of capturing upside in covered call funds. The problem with JEPI is that downside protection is not guaranteed. When we look at JEPIX, the mutual fund that implements the same strategy as JEPI, we can see how the fund would have performed during the 2020 pandemic crash. What you'll see is that JEPIX crashed almost as much as SPY. This becomes a significant concern when considering that the biggest risk with selling covered calls is the capped upside, especially on the recovery. Keep in mind that if your asset loses 20% in value, it'll take a 25% gain to recover to its original price. If JEPI can drop just as much as the S&P 500 but doesn't have the same growth prospects, it will naturally lead to long-term underperformance, inefficient, variable distributions. Of course, what's more important about JEPI is its monthly distributions. This is supposed to be a fund that retirees can buy without thinking much and live off the dividend payments. There are a few problems with this approach, though. While yields have typically ranged around 7% and as much as 12%, distribution amounts change frequently with volatility and JEPI's underlying holdings. For reference, JEPI's distributions have a standard deviation level of 9.31%, while competitor funds like GPIX and SPYI have distribution standard deviation levels of 1.64% and 2.12%, respectively. In other words, you can frequently expect JEPI's distribution to change close to 10% every month on average. This brings up a big discussion point for retirees and income investors. Would you prefer to reduce volatility in your underlying portfolio or your income? For most income investors, reducing volatility in income makes more sense than reducing volatility in the overall portfolio. So long as the portfolio values recover, having a stable income makes day-to-day financial planning far easier. JEPI's distributions are also primarily ordinary income for those investing in taxable accounts, with small portions classified as qualified dividend income due to their ELNs. Essentially, those investing in non-tax sheltered accounts will find their variable distributions even more difficult to manage. Ordinary income taxes are typically the highest tax rates, and with yields that can get as low as 6%, you are getting into territories where stocks paying qualified dividends can lead to more money in your pockets after taxes. If you make $60K a year, for example, 6.6% yielding VZ would lead to more money than a 7.16% yielding JEPI due to the 15% tax rate on qualified dividends versus the 22% ordinary income tax rate. Keep in mind that the tax rate on qualified dividends maxes out at 20% when you start making more than $500K, while ordinary income tax rates scale up to as much as 37% as your income rises. That said, please note that this is not tax advice, and it is always recommended to consult a professional tax advisor for your specific situation. Tax laws and regulations vary from state to state, not to mention from country to country. Buy GPX and SPYI instead of JEPI. While there once was a time when JEPI was the king of covered call funds, that is no longer the case today, with the numerous funds that have launched since. If we only consider funds that sell monthly covered calls, GPIX and SPYI are much better alternatives than JEPI for most income investors. First, their distributions are much more stable. GPIX targets an 8.5% distribution rate, while SPYI targets a 12% distribution rate. Comparatively, JEPI's yields range as high as 12.23%, or as low as 6.59%. This, however, isn't considering that both SYI and PIX have the capability of offering more tax-efficient distributions through using tax loss harvesting strategies to produce return of capital, ROC. Distributions that lower your cost basis in the ETF and defer taxes until you sell or when your cost basis reaches zero. SPII also has the benefit of using 1256 index contracts that qualify for 60/40 long-term short-term capital gains tax rates. Thus, you are more likely to end up with more income in your pockets investing in GPIX or SBI instead of JEPI, especially if you are factoring in taxes. Of course, the risk is that GPIX and XBI have not been around nearly as long as JEPI and are smaller than JEPI. GPIX was launched in October 2023 and has $482 million in AUM, while SPII was launched in August 2022 and has over $3.2 billion in AUM. Both pale in comparison to JEPI, which was launched in May 2020 and has amassed over $39 billion in AUM. This limited history means we don't get to see how GPIX or SPII performed during the 2022 bear market, nor the 2020 pandemic crash, which we got to see how JEPI may have performed via JEPIX. Fortunately, GPIX and SPII's strategies are much more transparent. Their call options are managed themselves, and the underlying holdings simply track the S&P 500. During down markets, we can expect the two funds to fall almost just as much as the S&P 500, with the only thing offsetting the losses being call option premiums. The benefit, however, is that GPIX and SPII are far better at capturing upside than JEPI. So even if the funds drop more than JEPI, we can expect the two funds to capture the recovery upside much better than JEPI, especially considering that GPIX and SPII will have an easier time reaching their target distributions when volatility is high and can open up larger portions of their portfolio for capital appreciation. Keep in mind that JEPI is not guaranteed to reduce volatility significantly too. The pandemic crash showed how JEPI could drop as much as the S&P 500, and in cases where losses are not preventable, you'd rather position yourself for the recovery. Essentially, GPIX and SPII offer more upside than JEPI and more stable income that's often higher and more tax efficient. When these two funds exist, not to mention other strong-performing S&P 500 covered call funds like various Euro DTE funds, it has become difficult for me to justify buying JEPI. Yes, JEPI offers lower volatility and has proven itself to do so during 2022. This lower volatility is not guaranteed, however, as the fund can still drop just as much as the overall market, as shown by how the mutual fund version, JEPIX, performed during the 2020 pandemic crash. Combine this with the volatility and tax inefficiency of JEPI's distributions, and it becomes difficult to continue to justify holding JEPI. Thus, I rate JEPI a sell and recommend income investors look at GPIX and SPII as alternatives. I have written multiple pieces on the two funds linked below as initial points of research. GPIX versus SPII. How to choose the right fund for you. GPIX capturing more upside than other monthly S&P 500 buy-right funds. SPII buy this for the 12% target distributions. This article was written by Kevin Shan.